Hello, my name is Martin Canter. I'm head of ethical artificial intelligence at Omina Technologies, and today I'll be speaking about fair lending, namely how to evaluate whether your credit scoring is fair or not. Omina Technologies is a trustworthy and ethical AI company which is located in Belgium. We have offices in Antwerp, in Brussels, but also in the United States, in Washington, DC, and Miami. We do believe that artificial intelligence is for everyone, not just a happy few. We've been producing AI solutions and putting them in production since 2016. And our clients are mainly coming to us to get trustworthy, explainable, transparent, and ethical AI solutions. So as I've said, I'll be speaking about fair lending. There are a couple of regulations and laws that already exist around fair lending, specifically in the United States and in Europe. And they state basically that fair lending, well, they prohibit any kind of discrimination with regards to credit transactions. If you want to look at fair lending, it's a little bit too complex to say whether something is fair or unfair. A better way to actually look at that is to understand and to define to which degree something is actually fair. If you want to look at the different range of the spectrum, we can look at a systematic and intentional discrimination system, such as for Associated Bank. That specific bank was condemned in 2015 to a $200 million settlement because they were discriminating and rejecting loan applications from Latino and Black communities. And that's really, well, an applied case of disparate treatment. If you actually don't perform intentional discrimination, but rather do it unintentionally, it's referred to as disparate impact. A couple of examples could be from Apple. The credit scoring mechanism that they put in place a couple of months ago was actually quite unfair. And for people with exactly the same background, but just with a gender difference, so basically between men and women, the woman would get access to to a worse credit score than the men, although they had exactly the same kind of backgrounds. So this would be an example of unintentional but direct discrimination case. If you look at unintentional but indirect discrimination case, an example would be the lending club. It's a peer-to-peer lender, which basically uses algorithms to predict if someone should get a loan or not. And for that specific scenario, instead of directly discriminating against specific ethnicities, because, well, they were discriminating actually against African Americans, instead of using that ethnicity, they were actually targeting, unintentionally of course, the zip codes. And since in some areas those minorities were actually more represented, refusing loans for people living in those areas was really affecting those minorities more than it should have. So this is an example of indirect unintentional discrimination. So if you want to go towards more and more fair lending, inclusive lending then is a most recent term that has been used. The good example for that would be Zest AI, that basically tries to provide fair lending through including not only financial data, but also data coming from different sources available. So if you want to obtain fair lending, we know that it's quite difficult. A lot of companies have tried that, have probably made mistakes along the way, as we've seen. And the most important for us is actually awareness. You need to make sure that if you go towards fair lending, you need to be aware of the different problems that can occur. Specifically discrimination, as it can have multiple sources. A couple of examples that we can give here, non-exhaustively, is mainly coming from data bias. So whether, well, if you're using poor data quality, sources that can have different and quite high error rates can lead to discrimination in your solution. Another example would be data representation bias. So if the data that you have does not really represent correctly the population to which you're going to apply your solution, and that you don't have enough data for minority groups, it can also lead to discrimination. Finally, you can also consider societal and historical bias. So for this type of bias, basically the data that you have basically collected in the past already includes some kind of discrimination. And then, of course, the solution, if you build one based on that specific data, is going to reproduce that kind of historical bias, which is already represented there. So another example of discrimination source would then be also model bias. So here, suppose that you've got exactly the same condition, the same data initially, and the same problem that you want to solve. The model that you're going to choose has also an impact on the type of discrimination, well, on the amount of discrimination which is going to come out of there. And different models have different sensitivities to discrimination and to bias. So here, really being aware of the source of discrimination that can occur and that can affect your solution is quite important. Now, if you look at a classic work process to actually build a fair lending system or just an AI system in general, we usually start from business understanding. We're going to gather different stakeholders, ask them to define the use case that we want to solve. How do we want to define that? What's the targets, the objectives that we want to attain? What kind of data do we have available and so on. From there, then you can start understanding the data that you have, prepare the data. You can then use that prepared data to start the modeling, to build an actual model, AI model, and then you send that to the evaluation step. If the evaluation criteria that you have defined in the first step is met, you can directly deploy that and go into production. Usually what happens is that you have to iterate several times to actually obtain the results that you're looking for. Along those different steps, AI and bias basically, bias and discrimination have to be taken into account. Unfortunately, we will not have the time to actually look at all the steps and what actions you can actually take. So we're really going to focus on the most important parts and actually the first ones, which are basically identifying the groups and the protected variables and specifying the fairness definition. We're going to apply that to a specific use case that I'm going to present right after. And we will present then at the end of this, we will show at the end of this presentation the results that we have obtained with regards to the fairness definitions that we've chosen, right? So the first steps towards a fair lending system is group identification. The use case, well, the data set that we've chosen here is a data set which is called a German credit data set. It's an open source data set that was published in the late 90s and which you can freely obtain on the internet. The data set contains data, and the data contains specific features which is separated into different categories. The first category allows us to estimate the liabilities of a loan application. So it's going to contain credit history, the number of existing credit already, other installment plans, and number of dependents, for instance. A second type feature that is contained in the data are the assets. So they're going to allow you to evaluate the financial capability of a loan application, namely with regards to the status of the existing checking account, of the saving account also, of the property. For example, do they own a house or are they still renting a house, for instance, and so on. The last group of features that we can look at also are the socio-demographic information. There, specifically, we're going to look at the age, job, whether someone is a foreign worker or local worker, and also then the personal status and gender, which is here grouped into one specific, one common variable. Since we don't have the time to actually look at everything all together and to identify all the groups, all the important points where bias and discrimination could occur, we are going to focus on one specific example, which is going to be the personal status and gender problem. Namely, do we observe discrimination between men and women? And since we also, for one specific fairness metric, we want to make sure that we're going to compare groups that are comparable. We're going to group them also on a specific condition, which is going to be the credit history. So do they have a similar credit history or not? All right. So now that we have defined the groups and the variables that we want to look at, we're going to define which kind of fairness metric do we want to use. there are a lot of different fairness metrics that do exist out there, and we're only going to be looking at disparate impact, equal opportunity, and conditional demographic parity. Those are the ones that seemed to us the most interesting one to present here. Disparate impact is one which is used quite a lot in the United States. Basically, you want to make sure that the groups that you consider, for our example, is going to be the men and the women. You want to make sure that they have a similar approval rate amongst all their loans. Specifically, the threshold which is set in the US for disparate impact to be deemed fair or unfair is 80%. With regards to equal opportunity, so a second metric that we're looking at, we want to make sure that the men and the women also have a similar approval rate, but this time not across all the loans, but only amongst the loans that were historically paid back. So the people that should get a loan, well, that can actually get a loan, should get one. That's what we're really looking forward with this equal opportunity metric. Finally, on the conditional demographic parity, what we're going to look at is to ensure that the woman, specifically that group, which is actually the protected group here, should not have a higher rejection rate than the men. And also they should not have a smaller acceptance rate than the men. And specifically also we're going to condition that on the credit history to make sure that we compare men and women that are comparable, that have a similar background with regards to their credit history. So before we actually look at the final results, to get you a better understanding, a better feeling of what those metrics actually represent, we've built here a small visual representation of those metrics. So let's say that we have a visual model for which we have data. The data, historically, we know that a loan was paid back, and we're going to represent that with a green bill. The loans that defaulted is a red bill. For the last metric, the specific condition that we want to look at, the loans that do not meet that condition are going to be grayed out because we do not want to look at those. If you look at the model, it's going to make predictions for men and women. We're going to separate them so that we can actually, well, look at them separately. All the loans that are approved are above the striped line on the right-hand side, and all the loans that are denied are underneath the striped line. So basically here, to get a better understanding, out of the 10 loans of the woman, 5 of them were approved, out of which 4 were actually good loans and 1 defaulted. All right? If you look now at disparate impact, how do we measure that? We're going to look at the group approval rate, and that's defined by looking at all the loans that were approved, divided by the total number of loans for a specific group. So for the woman, it would mean that 5 loans were approved out of a total of 10 loans, which gives us an approval rate of 50%. If you do exactly the same calculation, but for the men, you've got 6 approved loans out of 10, which gives you a 60% approval rate. Disparate impact, then look at the ratio of those 2 approval rates to see if the model is actually fair or not. Here, the ratio is 83%. So from a legal perspective in the US, it could be deemed fair, but it's just fair enough not to be actually unfair. If you compare that, for example, to the pay gap between different genders, a 17% pay gap is actually quite significant still. Second metric that you want to look at is equal opportunity. For this one, it's going to be also the positive rate that we're going to look at, but this time only for the loans that were paid back historically. So in practice, we're going to look at only the green loans. For the women, we know that 4 of those were actually approved out of a total of 6 loans that should have been approved. So the woman that should get a loan, out of those, only 4 got a loan, right? Which in technical terms, we also call that a true positive rate. And here, the value of this rate is actually 67%. If you do exactly the same calculation for the men, this time you obtain 4 approved loans out of 7 approved, well, that should have been approved. So it gives us a ratio of 57%, a true positive rate of 57%. Equal opportunity then takes the ratio of those 2 values. And we see that in the end, the model is actually deemed quite fair because the ratio between those two values is 1.18. So the women get more, well, out of the women that should get a loan, more women actually get a loan compared to the men that should get a loan. And one could even say that this model is actually quite unfair towards the men. The interesting part in this scenario is that if you compare that to the disparate impact metric that we've seen before, with exactly the same model, exactly the same data, and exactly the same decision boundary, you obtain two completely different fairness metrics. So it's actually possible to obtain different results depending on what you're looking at. And that's why defining the metric is really important. The last one that we want to look at is the conditional demographic parity. So for this one, we're going to look at the acceptance rate and the rejection rate, this time only for the women. Basically, what it means is that first, we're going to condition that on the good credit history. So only take the loans for which we know in the data that it has a good credit history. And then we're going to look at all the loans that were approved for the woman with that credit history. So it means 4 loans compared to a total number of approved loans, which here we have to add the 5 loans of the men that were approved. So it's a total of 9 loans. 4 divided by 9 gives us 44%. The rejection rate is basically the same calculation this time, but for the rejected loans. So 3 out of 5 is 60% of our rejection rate. And what you want to look at now is to see if the woman, sorry, with similar credit history actually will have the same representation for both the acceptance rate and the rejection rate. And here we actually see that it's not the case, that women have a lower acceptance rate than rejection rate compared to the total population. So in this scenario, the model would actually be deemed unfair. A fair model would have an equivalence, a complete equivalence of 1-to-1. So taking those notions back, we are going to look quickly at a classic machine learning pipeline that we've built using that German credit scoring problem. We've already defined the use case before. We've already looked at the raw data sets. We've just a little bit pre-processed the data sets. If you want to look at the code, it's available online. We've published it, so you can have a look afterwards if you're interested. Taking that data set, we then split it into a training and a testing data set. The training is used to train the model. The model that we've chosen is a CatBoost model, so it's some kind of boosted decision tree. And then we've taken that the testing data set to validate the model. The advantage of this model is that it's able to take into account penalty terms, so an error matrix basically that we've defined here. Basically, it means that you want to penalize the model when it's making wrong prediction. So when it's giving a loan to someone that should not give a loan, well, we're going to give it a bad score of 1. But if it's not giving a loan to someone who should actually get a loan, so for which we would actually make money, we give it a penalty of 5. Those values were actually defined by the people who have produced the data set. So we have not chosen that arbitrarily. It was already chosen before. If we want to evaluate this pipeline, usually, well, the most common way to do that is to look at the F1 score and specifically the accuracy of the solution. And you obtain here a weighted accuracy of 75%. All right? So this is a classic machine learning pipeline. What you want to do now is not only look at this pipeline, but actually look at it from a fairness perspective and see where fairness needs to be taken into account. What you've already done before is then look at the data and define the protected variables and the protected groups. From there, we've also defined a couple of fairness metrics that we need to look at. Best case scenario, you should not define a couple of them, but only choose one. The one that actually matters to you and the one which represents and which shows best the use case that you're trying to solve. Since we want to show here a couple of those, we're going to present the 3 results that we've obtained. At the end of the pipeline, then for a fair ML pipeline, you don't only want to evaluate the results that you obtained with regards to accuracy, but also with regards to fairness. And that's what we're going to look at now. So taking our German credit datasets, building our CatBoost model, and then looking at the result that you obtained, For the disparate impact fairness metric, so those similar approval rates amongst all the loans, we see that the female group obtains an approval rate of close to 44%. The males have a 47% approval rate. So the ratio there now is about 92%. It's not completely fair, but it's fair enough. If you look at equal opportunity, we see now that the approval rate of the female is 57%, close to 58%, and the approval rate of the males is actually 59%. And here the ratio is 97%, so it's actually even better. And well, we would deem our model definitely to be fair with regards to equal opportunity. Of course, in practice, it's not impossible to get an exact equivalence. There is also there is always some kind of statistical variation there. Last but not least, we want to look then at the conditional demographic parity. So here we're going to look at the representation of the woman with regards to the acceptance rate and rejection rate, and make sure that we only compare the woman with a specific credit history with the man with a specific credit, with the same credit history. And here in practice, we have 3 different credit history that we want to look at. The first one is the woman for which they actually already have an existing credit, but until now, that credit has been paid back. We see that here, the acceptance rate is 30%, rejection rate is close to 29%. So the ratio is above 1. Well, the model is definitely fair to them. For the women that do not have an existing credit anymore, and that historically paid back their previous credit always, we see that the acceptance rate is actually now 50%, and the rejection rate is 43%. So the ratio here is actually 1.16. They're really actually advantaged by this model for this specific group. It's definitely fair towards them. Finally, the last group that you want to look at are the women that either have a critical account or that do have existing credits at other banks. And there then we see that the acceptance rate is only 27% compared to a rejection rate of 38%. So the ratio between those is actually now 72%. It's actually much lower than 1. And then the model would definitely be deemed unfair for that specific condition and for that specific group. If we take then the average of all the ratios and average it, of course, with regards to the weight of all those groups, in the end, you obtain a ratio of about 92% for the conditional demographic parity. So it can be compared to the other metric. It's still quite fair, but not fair enough, especially for that specific third group of credit history. So what do we want to learn from that? It's basically that fair lending is quite complex to shoot at. It's a complex problem to solve. And as we've shown, the first step towards that is making sure that you know which fairness metric you're going to use. And you have to define that at business understanding, because you basically see that depending on the one that you choose, they do provide you with different results and different learnings. All right. If you want then a full process towards fair lending, well, first, to get fair lending, you want fair credit scoring. And fairness, as we've shown, needs to be a design constraint. It's not really something that you need to think about it at the end because, well, someone complained about the model not being fair. But you need to know from the start to ensure that the data is representative enough, that the data is not too biased, that you are already aware of the possible bias sources that you have in the data and the model, and that you know also what kind of metric that you want to use to measure fairness. Of course, then the next step would be to try to mitigate the bias that you have and the fairness problem that you might have in your solution. But that's a very complex problem that we can maybe speak about in the next presentation. So I do hope that this was an interesting presentation for you, that you learned a little bit more about how fairness actually works in practice for fair lending and in AI applications. If you need some help with that, we can always help you at Omina. We do have a consultancy department that can assess your AI readiness, and that can also produce AI solution and pipelines for you if you need those. We do have a platform if you just want some assistance, but not from our consultants, but directly from a tool that allows business users to develop AI solutions with very little AI knowledge and support. A lot of the process is actually automated, so we do that for you. And finally, if you're just interested about learning more about AI and learning how it works and so on, we do also have an academy where we can design specific courses depending on your needs. So thanks a lot for your attention, and I'll be looking forward to the questions and hoping that we're able to answer them. Thanks.